Hey YouTube, it's Dimitri, and today we're going to talk about Silicon Valley Bank. So SVB, the collapse has been going on. There's been lots of buzz, lots of articles on all the media, on LinkedIn, and people have been messaging me on LinkedIn. People have been asking on YouTube, Dimitri, can you tell us what's going on with SVB here? And to be honest, I haven't really paid that much attention because it's really not that big of a deal. I think it's being blown way out of proportion. But let's go through this a little bit from what I've been talking about over the last 5-10 years here. And let's talk about a little bit what's going on here and why they're having issues and why I don't think it's that big of a deal. So to start off with here, what really happened? Again, I don't have all the financials. I'm not pulling all this information out. But what really happened is the bank takes deposits. So banks that take deposits have a bunch of cash and they set it in their coffers. You have to be able to store that cash. So you have, the cost of like security, you have the cost of the building, it's like the real estate cost. And then you have all the employees that manage the funds, the security, the online platforms, the websites, right? So to run a bank, you have all these overheads. And let's just pretend for this sake and simplicity here, let's just say that you were just holding cash for people. Okay. So if everyone puts a bunch of cash in, at the end of the day, there's all these overhead costs and somebody has to pay that. Now, banks have moved away from charging fees for holding funds. And, I think it's a good thing. It allows people across the wealth spectrum to use banks to store their assets. Now, that being said, right, this looks like a horrible business model. So money comes in, you just park it, and then you have to pay to store it, but you're not charging anybody for all these fees, these overhead employees and management and security and buildings and all this to hold all this. So what banks do is they actually lend out this money in all sorts of ways. So people are like jumping up and down about the banks and how risky they are. If you have a mortgage, if you have an auto loan, if you have a credit card, if you have any financial product where you are borrowing money from a bank, you are borrowing somebody else's money. Okay, so a bank takes all this money and then they lend all this money out to other people. Now, all the people complaining about this, okay, I'm fine. Let's get rid of banks, right? Let's give me all your money back for your mortgage share. Let's kick out your family on the street. Let's kick out, all of the people out of the car. I'm going to take your house, your car, your credit cards, your college degree. I'm going to take everything back and you get nothing or we're not going to lend any money. I think that's unfortunately part of the reaction we're getting with this. And it's hold on. Let's understand this a little bit better and understand why SVB is just dumb. They just made a lot of poor decisions here. So what's happening here is that SVB decided, okay, we want to be really safe instead of lending these out into mortgages, for example. So imagine, a bunch of people give you money and then you make a bunch of mortgages and then you have monthly payments coming in from the mortgages. As you can see, there's a cash flow issue here. So now if everybody wanted their money out today, that money is locked up in mortgages. Right? You're not going to pay off your, $300,000 mortgage overnight. You're going to be making, your $2,000 payment back. And so what's happening with this is you have a liquidity versus solvency issue. And so Silicon Valley Bank, just lacked risk management understanding, didn't understand financial products, has no idea historically where we are in interest rates. We've been at an all-time low, which has been just held down by the Federal Reserve. And we'll get into how this ties into SVB and a little bit of corruption with it. But what happened was they bought a lot of really, really long-term bonds. And so they seem to be quite safe. I think they were government bonds, the long-term, really low interest rates, from a few years ago. So you might be getting in, 1 to 3%, somewhere in this range, depending on product duration. So how long that bond goes for. But the problem is you had all these bonds and then you could do the math and say, okay, we are going to be guaranteed enough cash flow coming in from these bonds to cover the overhead. So the building, the rent, the employees and all that stuff just to hold the cash. And if that was all they were doing, this was a stupid decision. And you might be thinking, but why, right? It covers the expenses. Well, they didn't plan on having a run on the bank. And of course, a bunch of famous people on Twitter, of course, my least favorite platform. Twitter goes out there and they're tweeting up a storm about everyone's the bank's crashing, pull out your money. Well, now there's a run on the bank. And now this has two folds to it. So since these are bonds, you should be able to go to the bond market and sell them and get the cash and cover the deposits. However, since interest rates have gone up, the price of those bonds have gone down. So the way to think about this intuitively is imagine you have a bond that's let's say a 10-year bond that pays 2%. and the current 10-year bond pays 3.5%. Which bond are you going to pay more money for? Like, the new bond with the higher interest rate has more value, right? You're going to get more cash out of it. So what happened is they had all these long-term bonds on the books. The prices went down. So even if they were to liquidate and get rid of all of these bonds, they could cover some of the deposits. But now when you have a run on the bank, so when everyone's panicking, you don't want to be the last one in the bank. So everybody runs. They all go and get their money out, because if you leave your money in, if they only have enough bonds to cover 75% of the deposits, the first 75% of the people are going to get their money, and the last 25% are going to get nothing. So that's what happened with the risk management here. That's why everyone's talking about, inflation and interest rates and everything. It's really because interest rates have gone up and they did not manage their interest rates well. Why you would buy a bunch of long-term bonds, I have no idea. This just sounds like a overly simplistic non-understanding of financial markets here, which is pretty sad because, the CEO here, which I have his LinkedIn profile here, Gregory Becker, you should know better than this. But yeah, they should have had, at least at minimum, they should have diversified and had a mix of durations of bonds and had a mixed bond portfolio here. There are other products out there, guys. There are other products they could have used. And that's why all the banks, if you look on LinkedIn, everyone's like crapping on SVB, on they're dumb, they're incompetent, they didn't do anything. But this also rubbed me the wrong way, because I don't know whose it was, and I'm not going to call them out, but there was a post on LinkedIn of some lady from some little peon bank, and they were like on their high horse about, they should have known about this interest rate risk, and they should have done this, and my small bank, we do all these things. I'm just like, the reason this bugs me is because I've worked at these banks. Like, I've worked at the big global banks, and I've worked at the smaller regional banks. The bigger global banks have a lot of people that run them. And so it's often harder to make as dumb of decisions because you have so many people that know what they're doing. Even if you end up with 5% of people know what they're doing and 95% idiots, you can still make pretty good decisions, because typically the 5% kind of raise to the top, and you can kind of keep things on the rails. But these small banks that are like, well, we know what we're doing and we're doing X, Y, and Z. Okay, sure, you have managed your interest rate risk, but I can guarantee you there are vast majority of risks that your bank is exposed to that you have no idea what's going on. Because I went and worked at these smaller regional banks, and let me tell you, smaller regional banks are super risky compared to global banks. The reason for this, smaller regional banks focus in on one very specific niche because they can only make money in one very small area, because that's all they know how to do. They can't diversify. They don't have intelligent people. They don't have model developers who can build models for other things. And the markets are far more complicated than you think. And so I was going to throw in a few little pieces here. Again, one regional bank that I was working at specializes in commercial lending. So they have minimal exposure to the retail side. So bank collapse wise, this specific risk, this specific crisis, this issue, not really going to impact them that much because they don't really have a lot of exposure on the retail side. So again, if they had a run on the bank and the retail pulled out, they have a lot of other funds and financing from corporations. So as long as those don't pull out and dry up too, that firm would be okay. Now, if there was an interest rate, as we're seeing interest rates are running, if there's an interest rate crisis or a crisis where commercial lending dries up, they might be screwed. And these banks aren't going to be well protected because they're not well diversified. Now, the other small regional bank I worked at, they could only figure out how to do commercial real estate, and they were doing it with the technology of someone in the 90s. Like literally take the big banks, put them back in the 90s. Maybe early 2000s, but more like the 90s. Horrible modeling, horrible validation, have no clue what's going on when they put all these pieces together. And yet, again, they're still operating. They seem fine. Like I've been looking at, people that are moving companies and leaving and kind of watching the news for the banks I've been at. They seem fine because, again, this crisis is only impacting a run on the bank that has to do with a bunch of poor decisions that a specific bank made. All the banks are impacted by the fact that interest rates have gone up. All the banks are impacted by inflation. But the thing is these other banks, again, shouldn't get on their high horses on how great and wonderful they are, because at the end of the day, they are focused in other areas. If there is a crisis in their area, I can tell you from the inside, they're not going to fare these storms very well either. So the banking industry, it needs more intelligent people in it. I have a whole video coming out on why banking is crumbling and falling to the ground in many ways. But a lot of this just comes to the fact that we've gotten away from capitalism. We've gotten away from, meritocracy of like, if you do really good, you get promoted. And unfortunately, this is not how banking works anymore. But before I get on that tangent too much, I wanted to point out here too, a lot of the banks are exiting markets because markets are a little harder to work in these days because we're in a recession. We've been in a recession. Wake up, banking community. Everyone's like arguing like, oh, are we going to hit a recession? We've been in a recession. The definition of a recession is the 2 quarters, with negative growth consecutively. We've been in that. We've been in a recession for a freaking long time here. And everybody's acting like, oh, no, Dimitri. Joe Biden and the Democrats here, they've decided, and the Federal Reserve, who's, in their pockets, they've decided that they're going to change the definition of what a recession is. So we're not technically in a recession. We've been in a recession. I don't know how else to tell you guys this. And since we're in a recession, banks are kind of pulling back and closing markets out of here. And I thought I'd point out a few things here. So Wells Fargo is one of the largest banks here as well. There's articles all over how Wells Fargo is backing out of the mortgage market. They are not exiting 100%. I believe they're still doing mortgages for high wealth individuals or current customers who look like they're good fits. But they are the 3rd largest mortgage lender in the country at the time of this other article I'm looking at, which was January 11th, 2023, or so a few months ago. They're exiting. They're trying to get out because mortgages are so challenging, because the mortgage market is so screwed up. Housing prices are just ridiculous. Building new homes is starting to come down. The market's starting to contract. Inflation is hitting. We are in a recession. We've been in a recession. So Wells Fargo has already been backing out. So that's one big player. Now, the other big player I kind of want to pick on here a little bit is Goldman Sachs. So Goldman Sachs is known to be a quant house, a heavily focused model group. And unfortunately, a lot of that comes to the fact that they are very market focused. They are buy side more specifically. They like to be in the markets and the stocks and the bonds, and they want to be on the instrument side of this. They have not been in the retail side until they opened up Marcus, which was their digital full scale retail banking thing. And in October of last year, they announced basically they are trying to get out of that, and they're closing that out because retail banking is actually much harder than people think. So I get this a lot from the quant community in the sense that everyone goes, oh, I want to be a Wall Street trader, and they're really smart and they're geniuses, and people that work in credit risk are dumb, and people that work in banks and risk management, you're all idiots. No, it's much, much harder. There are much more complications within the modeling framework. So if you don't know this, if you're new to my channel, banks are driven by statistical models developed by quants in most areas. There are some areas like commercial lending where you have one-off giant deals. There's not a lot of data, but retail banking is super data driven. The marketing approach, the marketing strategies is all collection of data and targeting customers and getting into these points here. If you're not sure what Marcus is a digital banking side of Goldman Sachs. They did high yield savings accounts, which has been their big push. Anyways, but you also need models to do marketing. You need models to actually price out loans. If they're going to start getting into the retail side, they want to do loans. They have to price out products like mortgages, auto, credit card, all of that. It is complicated. There are a lot of models on loss modeling, which consists probability of default, exposure at default, loss given default. There is a whole system of regulations with CCAR and DFAST that all come into this with CECL, for example, because you have to be CECL. And CECL impacts anyone that does lending. And of course, if you're a large bank like Goldman Sachs, you can't just do the, back of the envelope moving average in Excel like some of these little credit unions do. You have to actually have statistical models. And of course, Goldman Sachs has a whole division of quants, and they have validation teams, and they are heavily regulated. But getting into this market is very competitive. Very competitive. And you have to be able to be nimble, and you have to make good decisions here. Now, I don't know the exact reason on why Goldman Sachs is closing out of this and why they're stepping away. But with that, they have realized that they are not competitive in this space. And again, if we're in a recession, which we are, a lot of these firms and banks strategically are looking at, okay, we've got X amount of capital. We need to start closing out riskier new ventures. We need to start hedging up and making sure we have capital on hand. So if people start pulling money, So again, these bigger banks understand this. They're well prepared if people start pulling money, that they should be able to sell enough assets and have enough liquidity in those assets that they can sell them and get a decent price for them and actually cover their positions here. So anyways, in conclusion of all of that, I'm not super concerned with all of the other banks here. I think this is really just a bad decision, bad step on a few small banks. Again, tech's imploding because tech has way overgrown. They way overhired. I mentioned a little bit of concerns with this when I moved from banking into fintech, and I talked about stability concerns with moving into the techie space and why I didn't go into a FANG company, or they call it a mega, whatever, with Microsoft in there now. But the FANG companies, I avoided the tech industry because, guys, it's coming back down. We're in a recession. Those really fun, exciting cell phones that you have that are a big, massive waste of money. You don't need them. You don't need new technology. People are cutting back, and the inflation is forcing this because things are getting more expensive. So when the government issued all this fake money that they generated out of thin air, it has to get eaten up somewhere. So prices of goods have to go up because we can't make more goods to keep up with that new money. There's no value behind that money. No one actually earned it. And because of that, inflation's going up. And now the market in itself, the wild beast that a market is absorbing all these dollars back into basically oblivion. It has to crush those dollars out somehow. So prices have to go up. So when you go down there, you can't pay, $2.50 for a gallon of gas. You got to pay $4.50 now because, it's inflation. That's what happens when there's too many dollars circulating. Now getting into this SVB a little bit more on some of the issues. One of those being, it seems like the CEO here, so Gregory Becker here, it seems like he pulled out and sold $3.5 million of shares that he had weeks before the collapse. So this seems sketchy in itself because as I'm talking about the run on the bank and the assets and, there being enough capital to cover all these positions, it seems like they knew something else is actually wrong above and beyond the run on the bank. So I don't know if they just saw that, there's an issue with the interest rates. And so they have these long-term bonds. And so, there might be a run on the bank. I think there are other financial issues internally in the way the bank is ran, both on the liquidity side, but on the solvency. So there are long-term financial obligations. They might have not been able to make those as well. And of course, as all this is coming out and as people are taking apart the financials, we're going to start figuring out more and more information on this, but it doesn't seem to be available currently. But that's really an illegal move. You can't, it's like, it's insider trading, guys. Like, I run this firm. I know it's going to collapse. I pull all of my money out and I run. And then when it goes under, like, too bad to my clients. Just not a really good thing to look at. And something else I think was a little sketchy here as well. So I am a huge critic against having practitioners as regulators because it is a really challenging problem to address. With financial institutions, they get fairly complex. There's models. Most executives, most chief risk officers, most CFOs have no idea about the complexity of most of their banks. They have lots of smart people, unfortunately, in the bottom that aren't in the top, and they're actually having to build out models and statistics and do all this risk management practices behind the scenes. So most CROs do not have a quantitative degree. They have almost zero understanding of how the models actually work behind the scenes because guess what? They've never built one. They don't understand one. They just get the basic summary from the person who built the model. And that being said here with that, how do you get qualified regulators? Well, you kind of have to pull them from the industry, and there's kind of this conflict of interest here. Well, it looks like if you pull up Gregory Becker's Wikipedia page here, it looks like he was also serving as CEO of Silicon Valley Bank, but he's also on the board. So he's a board member of the Federal Reserve Bank of San Francisco. So you're not even a regulator. You're a regulator and a CEO at the same time. Tell me there's not some sort of corruption going on here. How is this possible? How did we go through Dodd-Frank back in 2010 when that was implemented? And we've had CCAR and the banks have cried and wailed and had all these issues. We needed to go back and make everybody stick to the original CCAR, in my opinion, because we reduced it and tried to make less costly for all these banks in 2018, I believe, when they did a readjustment. And now many of these banks have what's called HCR, so Horizontal Comprehensive Capital Assessment and Review, horizontal capital assessment review. But they've scaled it back here. And that's a little bit of a mistake. And then the worst piece of this is ESG is now like the shining beacon of risk that we all need to worry about. And then magically we've got SVB collapsing. We have Wells Fargo pulling out of markets. We have Goldman Sachs closing divisions. We have banks doing mass layoffs, techs doing mass layoffs. And we're worried about ESG, but at the same time, like, right, we have more serious problems. I'm not sure why we're reducing regulations and then increasing regulations in stupid areas like ESG when that's not going to be the issue with, you know, all of our money here. So how is he serving on the Federal Reserve Board of San Francisco, and Silicon Valley Bank was based in California? So I'm guessing that was probably their regulators. That's just a huge conflict of interest. And even if they were to bring in the Federal Reserve from somewhere else, like the New York Federal Reserve, for example, and brought them in to do the audit, or the Dallas Federal Reserve, you still have the conflict of interest that you all are tied together. You know everybody. There's already the conflict of interest that bankers already know the people that are the regulators because they deal with them every single year. So you build relationships with them. But then if you're on the board for this, yeah, it makes complete sense why the government swooped in and saved SVB and all their deposits. So I am strongly against the saving of SVB. They should just let the whole thing crumble. No, I don't think there would have been a run on the banks with all these banks collapsing like everyone's predicting. Just pointing this out that like they're tied together seems kind of fishy on the bailouts. Now for FDIC, so Silicon Valley Bank was FDIC backed. So all the deposits for anyone who had money up to $250,000 would have been covered. That should have been honored because every consumer knows that rule. They tell you that when you open your account. Common sense. Now, if a bunch of tech gurus or geniuses here were too stupid to realize they should diversify across different banks and into different products to protect their assets so that they didn't have this sort of issue, too bad. Like, you made a bad decision. The bank made a bad decision. You made a bad decision. You both should take the losses. I don't understand why we're like trying to step in. Like, everyone's trying to spin this in control. Like, oh, we need government. It's going to solve our problems here. Government's going to fix this. It's going to stop this run. I've talked to a lot of the regional banks, and like the memos going out from CEOs is like, yes, this is terrible. Yes, this is, you know, risky and it's unfortunate for the industry. But, you know, we don't have any ties to SVB. We don't have interest rate exposure like they do because we all hedge that. Like, a lot of these other banks aren't going to collapse just because SVB collapsed. Like, if one bank goes down, they all don't go down. Now, everybody keeps saying as well, they're like the 16th largest bank. They're like 212 million or billion. They're not even technically federally regulated in the sense that they are going to be what's considered a DFAST or CCAR bank. So CCAR is the big dogs. DFAST is going to be the smaller banks. I believe the cutoff's like 250 billion in assets. They're at like 212. They're not there yet. So again, ever I'm reading, it says Federal Reserve was their regulators. If they were, that seems sketchy and risky. If it's FDIC does far, far, far less regulatory requirements than the Federal Reserve does or the OCC. So they were either under-regulated, so it's kind of on FDIC if they're the regulators, or if it's Federal Reserve, it's on them as well. Like, who didn't catch this either? Like, I mean, they made poor decisions and they should pay the price, the bank should. But again, it's the regulators and the government's fault as well for not even looking at these sorts of things. Right? Like, I've criticized the regulators for years. I've done it when I worked at the banks. The regulations we have are kind of like a check the box mentality because we just don't have enough qualified people in there. How do we fix this? Education, education, education. It's why I spend almost all of my time working with universities and trying to get people better prepared to understand what risk management is and what banking is. But anyways, that's what's going on with SVB here. Yeah, all these small banks as well, they have different exposures to risk, so they can't really stand up and like point the finger and say, oh, they're idiots. Yeah, you guys have other stupid decisions as well. I don't think risk is being managed very well in the industry. Do I think there would have been a massive collapse if government didn't step in? No, I don't. I think a bunch of the sketchy tech banks and crypto banks would be going down. That's already happening, right? FTX already went under. FTX is taking a bunch of them down. I mentioned there seemed to be some weird corruption with Binance as well. Back in the original video I made before Binance got kind of sucked into this as well. There's just sketchy, illegal things going on across the board with crypto. The banking industry just seems to be caught up in this in the sense that they didn't manage their risk. banking 101. Now, for the consumers in this bank as well, I don't feel bad for them because FDIC should back the $250,000 limit they back for every U.S. citizen at an FDIC bank. But the unsecured deposits should just go up in flames. Like, you made poor decisioning as well. Like, everybody made decisions. You've got to pay the price. That's just life. So that's my take on SVB. That is my take on the markets currently. Thank you for listening. Thank you for watching. Don't forget to like, share, and subscribe if you found this video interesting. And as always, until next time.